Thank you for being on this video with me. My name is Rodney Constable. I am the president and founder of Simple Market Signals at simplemarketsignals.com. Simple Market Signals helps you understand the level of risk in the stock market through our proprietary market risk signals that are emailed to you every weekend as part of our weekly stock market-based newsletter, all for less than $20 per month. Today we will be doing technical analysis on the S&P 500 for Friday, May 15th, 2020. For this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. Today we were up 0.39% on the S&P 500 and closed at 2863.70. The first chart that we're looking at here is a 5-day chart of the S&P 500 where each candlestick represents 5 minutes of trading. Over on the right-hand side here, you can see that for the day we gapped down at the open, traded up to the dotted blue line, which is where we closed yesterday. So that would be the unchanged line for the day, backed away from that, and then finally at about 2 o'clock in the afternoon went positive and then kind of traded sideways for most of the afternoon, and then just for about the last 15 minutes of the day, we had a push, including some volume coming in at the close, which is not completely unusual. You can see that pretty much every day for the last 15 minutes of the day. The good news for today is that it was positive volume and it pushed the market to the highs of the day. Again, we closed right here at 2863.70. Now, for the week, we can see that we were negative for the week, and you can see on Monday we had a pretty good day there, but Tuesday and Wednesday sold off pretty hard, and Thursday gapped down at the open, and then for the week here, we hit our lows of the week right around the 2766 level, which is really important because if you go back about a month, as we've seen on some previous charts, and if you want to see that, you can go back over the last couple of days' videos, but we hit this low and it kicked in some buying algorithms, and you can see that it pushed us back up above this 2800 level, which is where this blue line is setting. And then, of course, we've got some more support right around 2794. Again, that goes back for a couple of weeks or so. And again, all of this can be seen, these support levels and the importance of those over the last month or so can be seen on previous videos from this week. So if you want to check that out, go ahead and check out those previous videos. But the important thing is that we know that we're being supported by algorithms right around these levels, and it's keeping us above, at least for now, it's keeping us above this 2800 level on the S&P 500. This next chart that we're looking at is a year-to-date chart of the S&P 500 where each candlestick represents 1 day of trading. Of course, we have the Fibonacci retracement levels overlaid on top of this chart. And the trading here, the algorithms are keeping us just, going back and forth kind of like a ping pong ball between the 50% and 61.8% retracement levels of this entire move that we saw from February 19th through March 23rd. And again, this week's trading kept us, solidly in the middle of this trading range, which is setting right around the 2793 to 2935 levels on the S&P 500. So, the question for next week is, can we continue to do this? Can we stay in between this range? At some point, we will break out of this trading range between these two levels, and that will dictate the direction of the trend at that point. So if we break to the downside, then I expect that we would go down to somewhere between the 2630 and 2650 levels on the S&P 500. If we break out to the upside, then we're really going to be fighting some overhead resistance at 3,000 or above, or even at 2950 and above. Only time will tell, but for right now, we're stuck in between this 50% and 61.8% retracement levels, which again are setting around the 2793 and 2935 levels on the S&P 500. This next chart that we're looking at is a 5-year chart of the S&P 500 where each candlestick represents 1 week of trading, and the blue line is the 40-week moving average, which of course is equivalent to the 200-day moving average on a daily chart. One important point on this trend line, before I forget to mention it, is the fact that it is trending downward. You can see this. That is negative, okay? So when you have a downward trending long-term trend line, right? The 40-week, the 200-day moving average, and that thing is going down. That is not a good sign, all right? And you can see here that for the week, we were negative 2.26% on the S&P 500. And again, we're trading, well below the 200-day moving average, the 40-week moving average. And you can see here that, we've been predominantly going sideways here for about a month now. So, overall, the trend is still not great. And yes, we're off the bottom, but we're still a ways off the top as well. We're not trading above the 40-week moving average, the 200-day moving average. You are not in a long-term uptrend until you are up above the 200-day moving average. Now, with simple market signals, I don't use the 200-day moving average, but I know a lot of people use it. It's very traditional, so that's why I threw it in here, and it is a good gauge. And whether you're using Yahoo Finance or whatever you do your charting on, the 200-day moving average is a pretty standard moving average to use. So that is why I have it in here, so that you guys that are watching these charts, regardless of where you are in the world, you can use the 200-day, the 40-week moving average to keep tabs on what's going on. And you can clearly see that it is very important. It's a moving average that has been used by traders for decades, so it is an important gauge of what's going on. But when you're underneath the 200-day, the 40-week moving average, you are not in a real strong market. This next chart that we're looking at is also a 5-year weekly chart. This time we're looking at the Russell 2000 through the IWM, the ETF that tracks the Russell 2000. And I like to use the small caps to verify what's going on in the large caps. One thing to note here that we were down 5.48% this week on the Russell 2000, so a lot of weakness in the small caps. And again, it's really hard, guys, to have a long-term sustainable uptrend in the S&P 500, in the overall market, if you have a lot of small cap weakness. And you can see here that these small caps are just really struggling. They were down over twice as much this week as the S&P 500, and we're just not seeing the strength in the lower end capitalization companies in the stock market. So definitely something to keep your eye on. Again, that long-term trend line is down. That's not good. And also an important point to note is that the Russell 2000 really peaked back in 2018, kind of did a double top here at the beginning of 2020, and has been in a downtrend since. Keep in mind, guys, there's still a lot of uncertainty out here. This is by no means a safe market by any stretch of the imagination. And there's no guarantees that the stock market is going to continue to rise, even if we get more stimulus. So please don't be overly confident and get complacent when there's so much uncertainty still in these markets. And the charts are telling us that. Now what we're looking at is a 20-year chart of the S&P 500, where each candlestick represents 1 month of trading. And what we can see here is for the entire time span, we are up and to the right, as you would expect on a long-term chart. Of course, we have the downturns 2000 through 03, and of course 07 through 09 right here. And this is the most recent trading action for the last couple of years on the S&P 500. And for the month of May so far, you can see we're down 1.67% on the S&P 500. This next chart is a 20-year chart of the MS World ExUS index. So this index tracks 22 developed countries outside of the United States. So basically, I use it to get a gauge on what's going on around the world outside of the U.S. And what we can see here is that for the last 20 years, this is kind of interesting, we are basically exactly on this index, we're exactly where we were 20 years ago. Okay, so sideways trading action, of course, we've been up and down, but where we're at right now is exactly where we were 20 years ago outside of the United States. This other thing that we can see here is this trend line that I've drawn going from the peak that this index hit back in 2007, and we've been in a downtrend in this index since 2007. And you can see here what's happened over the last few months. And one last point here on the MS World ExUS Index, it's down 4.10% for the month of May so far. The next chart that we're looking at is a 20-year chart of the S&P 500, except now I've overlaid the MS World ExUS Index on top of it. So the solid black line is the MS World ExUS Index, and of course the candlesticks are the S&P 500. So what's important about this and why it's so important to look outside of the U.S. and ascertain what's going on around the world is you can see that the global markets are hinged at the hip, and you get your strongest rallies in the S&P 500 in the U.S. markets when the rest of the world is doing well also. And you can see in years like 2013 and 2017 where the stock market was really strong, you've got the S&P 500 going up, and you've got the global markets going in the same direction. So the overall performance of the rest of the world, it's definitely important, but directionally, that's what I really look at. So we want the U.S. stock market and the rest of the world going in the same direction. And what we can see here is that we had this peak back at the end of 2017, beginning of 2018 on the MS World ExUS Index, and it's been in a downtrend for over 2 years. And it's really going to be hard to have a strong rally in the U.S. stock market if the rest of the world is not doing well. And keep in mind that 50+% of the sales and revenue of the mega cap multinationals that make up the Dow, that make up the S&P 500, 50+% of the sales and revenue of those companies come from outside of the U.S. So even if we're primarily investing in the United States, in the mega cap multinationals, in the Dow, in the S&P 500, or even the triple Qs, the NASDAQ 100, even if we're investing in those types of investments through the ETFs or whatever, we have to understand what's going on outside the United States to get realistic expectations of what might happen with our investments here in the United States. So, guys, do not ignore the fact that we've had global weakness. That is not going to help us as U.S. investors. We are fighting a massive headwind here, and these markets are just not as strong as I think a lot of people think they are. Now what we're looking at is a chart of 2018, and I have this annotated with the Simple Market Signals signals. So these are the weekly signals that come out and are published in the newsletter. And so what we can see here is the signals, the Simple Market signals are green, yellow, and red. So I'm just going to go through this very quickly. We're going to take a look at a couple of charts, but I want you to understand how these signals work and how they can help you. So first off, we have the green signal, and the green signal is the best risk-reward signal for equity investors. And what you're going to see here is that most all upward progress in the stock market is going to be made when the signal is green. And then we have the yellow signal. Now, the yellow signal indicates change, and generally what happens is after a green signal environment, then the signal will change to yellow, and if the sell-off gets bad enough, it'll change to red. Now, in this time frame here, we had both yellow and red signals. I just kind of clumped those together just to kind of give you an indication of what happens. It's very, very hard to make money in the stock market when the signal is either yellow or red, okay? So again, most all of your upward progress in the stock market is going to happen in the green signal environments. During a yellow signal, you're either going to be sideways to slightly down is kind of the realistic expectations, but oftentimes that yellow signal will be that transition signal between a green signal environment and a red signal environment. So in 2018, we went green, we were green here, and then the signal went yellow here, and then it turned red, and we'll take a look at that here in just a second. The red signal is your worst risk-reward signal for equity investors, and your worst downturns, including bear markets, happen during a red signal, and we'll take a look at this here in just a second. Now, let's focus on this time frame right here where the signal went yellow, and we're going to switch to a chart that's going to straddle from September of 2018 through March of 2019, because I want you to understand what happened here. So right here, we had this green period, and then the signal went yellow here. And so what we're going to do is go over here. So right here is where that signal went yellow, all right? And then a few days later, the signal went red right here, and that was in October of 2018, as you can see down here. And then we had some sideways choppy movement, and then a quick sell-off We bottomed right here in the latter part of December, and then the market started a rally. Now, a couple of things to understand is the market will bottom during the red signal, okay? Because again, remember that simple market signals, the weekly signals, measure risk levels in the stock market. So green is your best risk-reward ratio for equity investors. Red is the worst risk-reward signal for equity investors. And a yellow signal indicates that there's change, that risk is rising, and sometimes that risk gets bad enough that that signal goes red, okay? But anyway, so we bottomed here. The market started to go up, and we can see here that the signal went back to green right here. During shorter red periods, oftentimes the red signal and the green signal come out at about the same price level, okay? And I'll show you here on another chart in just a minute that the longer the sell-off, the lower that green signal is relative to where the red signal came out, and that'll make sense here in just a second. But again, this is just based on market metrics and market internals and things that go into the model, and it's about risk levels, okay? So if you get one of these quick sell-offs that rebounds very quickly, your red signal and your green signal can be in a very similar place, okay? So just understand that simple market signals measures risk in the stock market, and as you can see here, these rally attempts, right, because this was red, right, we went red here, so you get these rally attempts that fail, and then it sells off hard, rebounds pretty quickly, and then the signal goes green here, all right? Now, we're going to pick up right here, so this, again, is that transition period right here, all right? So now we're going into 2019. This is calendar year 2019 in the S&P 500, again, daily charts. So this is that red period. The signal went green here. So you can see here when the market is green, this is the best risk-reward ratio for equity investors. And during the green periods, this is where most of your upward progress in the stock market is made. Let's move back and go back to 2007 through 2009, and now we're looking at weekly candles. And what I want you to understand is when the market goes into a prolonged bear market, what really happens here, okay? So now we're going back again. This is 2007. The signal, the weekly signal, when I back tested this, because remember, the model came together in 2017. I worked on this for 20 plus years to figure this out. Finally, all the components came together in 2017. So what we were looking at here, okay, what we're looking at here is actual data. These were the actual signals that the model generated in 2018 and going through 2018 to 2019 transition as we looked here, and then 2019. So this, however, is back testing. So the original red signal that came out during the bear market that started in 07 and ended at the beginning of 09 came out right here, all right? Again, around 1,500 on the S&P 500. And as you can see, we, sold off for a few months. We had this rally attempt that failed and then sold off hard again, bottomed, and the market started to rise, and the signal came out green here, all right? So this is what happens during longer sell-offs, during longer red periods. Your red signal and your green signal have a huge price differential. Just between here and here, the market was down about 40%. Now, if you lose 40%, guys, it takes 66% to get back to break even. All right, so just to get back to 1,500 after if you've got 875 left and you're trying to get back to 1,500, that is over a 66% gain that's going to be necessary to bring you back up to break even. All right, so this is where simple market signals can really, really help during all market phases. But if it can help you minimize your losses during downturns, regardless of whether it's a multi-year downturn that ends up being a super long bear market or a shorter downturn like this, if you can use the signals to help minimize your losses and maximize your gains, right, during the green periods, that is where this thing is really going to help you, okay? So the whole key here, and this is where most people get it wrong, is start with the stock market first. What is the overall market environment like? Whether you're trading the S&P 500 through, SPY or a mutual fund or whatever it is, or you're working in the Dow, or you're working in the triple Qs, or you're trading individual stocks or options, you need to get the stock market right first. What is the environment you're working in, okay? Are you in a green environment? Are you in a yellow environment? Are you in a red environment? Get the market environment right first, And then everything else becomes so much easier after that. I hope you've enjoyed today's analysis. Please remember to subscribe to this channel, give me a thumbs up on this video, and also check out some of my other educational videos on this channel. I have a lot of great stock market related videos on this channel. And if you are a financial advisor or an individual investor that manages any of your own money, including in your 401k, 403b, IRAs, or your trading account, I would encourage you to take a serious look at Simple Market Signals, which is my personal risk management model that I have now made available to the public. For those of you who would like to learn more about how Simple Market Signals can help you in both up and down markets, here's some additional information. As part of the Simple Market Signals model, there are two powerful indicators. There's a risk-based indicator and a trend indicator. As a subscriber to Simple Market Signals, you will receive information on what the risk level is in the overall stock market, as well as what the trend direction is in the overall stock market. So this really, really helps. The way we disseminate the signals to our subscribers is via our weekly emailed newsletter. So within the newsletter, every weekend, you will receive the proprietary risk level signal on the overall U.S. stock market. You will also receive the proprietary risk level signal on all 11 major sectors of the S&P 500. You will also receive the early bird indicator, the trend direction signal on the overall U.S. stock market. You will have market and sector performance information on multiple time frames. You'll get market commentary and a weekly recap of what happened in the market. You'll have technical analysis information, fundamental analysis information, and yield curve information. There is a ton of information in this newsletter every weekend. And a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents a day. It's billed monthly on your credit card. There's no contracts. You can cancel anytime, and your first 2 weeks are free. Now let's recap what you get with your subscription to Simple Market Signals. You get the weekly emailed newsletter with all of the contents we just talked about. You will also receive special midweek updates when warranted. So if there is a major signal change or direction change, we're not going to wait until the weekend to get that information to you. We will send out a special midweek update when necessary to keep you up to date as to what's going on within the model. And the best fit for a subscriber for Simple Market Signals is somebody that has at least a 6 to 8 week time frame or longer. So if you're a long-term investor, you're going to love this. If you have at least a 6 to 8 week time frame that you focus on with your trading and investing, you're going to love this. If you're an ultra short-term 1 or 2 day trader, kind of a day trader, or somebody that trades within a week, Simple Market Signals might help you a little bit. But the reality is, the people that are going to benefit the most from a subscription to Simple Market Signals are those people that have at least a 6 to 8 week plus time frame that they're focusing on. And if you want even more information on Simple Market Signals and some of the strategies that you can use on the various signals, this is a very in-depth video that I will have linked in the description box below this video, along with a bunch of other videos that you may want to explore if you need additional information on Simple Market Signals before you subscribe. Also, keep in mind that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, that is just due to international compliance regulations. And to subscribe to Simple Market Signals, all you have to do is go out to the website that you see here, https://simplemarketsignals.com. It'll take you about 4 minutes to subscribe. It's that simple.